Yeah. I put my hands in the sky, wave them side to side. Tattoos on my arm, living like it's do or die. To the day I die, all this that I'm facing. Made it from the bottom to the top. Say I made it, say I made it, I made it. Now I'm taking lanes, say I made it, I made it. Now I'm taking lanes, I made it, I made it. Now I'm taking lanes on them, now I'm taking lanes, taking lanes, taking lanes on them. Hollywood knew this was a hit when it came on. You ain't getting paid home. What the hell you playing for? Get up out the game, bro. This is not for you. Do your the favor and then go back to school. Wanna hate this school and let these take their food. Swimming in this money, homie. Get the hell up out my pool. Double record spinning. Jumping, claimed I was famous. Hanging out with pretty faces. Wasn't flowing from that. Ain't no money coming out of my. Just some cold hard cash sitting in this black bag. Paper to be made. Man, you know we live that stupid life. If she get my wedding ring, know that she is super tight. The world is packing, we get a
Happy Friday. Getting money, whatever it takes, up to the top without no breaks. Happy Friday. All right. I had to change lanes on y'all. If y'all didn't notice, I don't use anybody's music, all right? Any music that y'all hear are from my artist, okay? All right, I don't want to pay nobody out there, but I do put my artist on, all right? So any music that you hear from me, just know those are my artists, all right? So let's talk about shorting today. How to make money on stocks going down. How do you make money on stocks going down? So this is a special today. Why? Because on Tuesday, the market fell very, very hard. It fell hard. And I see a lot of you guys running out into the market and you're trying to short the market right now and you're trying to figure out why it went up the next day. Guys, when the stock market falls in price, I want you to use the Ichimoku, right? I want you guys to use the Ichimoku in the 1 hour chart to kind of figure out what stocks are beneath the Ichimoku. I want you to use the what would Joe do method for entries, but I want you guys to understand that when the market falls, it falls way faster than it goes up. I talked about this in my Ask the Trader video that I did earlier, all right? We always take the stairs up, but we take the elevator down. We take the stairs up. We take the elevator down. When the market sells off, it sells off fast and furious. We like, advanced traders kind of like to look for the third day. Even Kramer talks about that. Around the third day, when the market sells off, that's when stock pickers like me start to come in. We also like to buy stocks, when they're down 5 or 10%. So when you get a big down day, usually it happens for like the next couple of days before it stabilizes and goes back up. And usually there's a support area that it broke. It'll probably go back to its support area, which became resistance before it started to go back down. Now, if you don't understand support and resistance and trend lines or any of the terminology that we talk about today, I want you guys to go register for Webinar Week. All right, Webinar Week, I think is somewhere in here. Webinar Week, guess it's not in here. But there is a link for Webinar Week. There is a link right here on my last Ask the Trader video. I don't know why it's not here, but there is a link right here where you can register for Webinar Week. Webinar Week is going to be October 12th through the 14th, the 12th through the 14th, and I teach the fundamental basics of the market. But I'm going to show you guys some shorts today. I'm going to show you guys some shorts. I'm going to also show you guys, how to buy some puts, how to look at those puts on charts. And, I'm not going to go in super detail, but I want you guys to take webinar week so you're able to do it. You always have access to me if you need a consultation. Now, I have to suspend consultations for the next 2 weeks because I have jury duty. But after those 2 weeks, because school just started, my hours are not going to be the same. I'm out and about a lot now. So what I would like for you guys to do is give me a time that works for you, and we'll try to figure out a time where you can get that consultation in. Now I'm opening up my consultation 7 days a week. All right. But if I'm busy, I'm going to do whatever I need to do, right? But if I'm not busy and I'm available to give you a consultation, I'll try to make something work out, with your particular schedule. But the first thing we want to look at is the spiders. So let's look at the spiders, and we're going to look at it on a 200-day moving average chart. Let's change this chart to a clean chart. So let's turn this to a clean chart, and just let's look and see what the spiders has done over the last couple of days. Now my chart's been jumping lately, so if it starts to jump or twerk like it's been doing, I'm going to go to a 12-hour chart. So if you notice, this is what happened the last week. All right. So this is the spiders, which is the S&P 500, and the S&P 500 represents the 500 largest companies in America. So this is what traders and investors use as a standard to kind of figure out what's going on with the market. The S&P is the market. Why? Because it has the most companies and the largest companies. Now, the Russell 2000 has 2,000 companies, but they're small cap companies. These are the largest and the biggest and the baddest. Okay. So on last week, this is 2 weeks ago. This was on the 17th, September the 17th. The market sold off. Then we came in on Monday, and the market was down. Now, remember how I told you guys the market will sell off 1 or 2 days, and then start going up again? Well, think about this. This was day 1, it sold off. This is day 2, it sold off. This was day 3 where it was up, but then it still sold off. Then traders started to buy it up. Then it went up back to 8. You remember how I just told you guys it's going to go back to a resistance area or a support area? This used to be support, which is the 50-day moving average. It broke support, went back to resistance, and then your other short sellers that missed this move jumped right back in and started shorting it again. Now, this is what's scary, because this was a sell-off day, which was the 27th. It sold off here the 28th, the 29th, and the 30th. It sold off for 4 days. We usually see it sell off 1 day, 2 days, 3 days, start to balance out before it starts to go back up again. Well, it sold off for 4. So it sold off 1 extra day, right? So if you're just one of those traders that just have to trade off of the the lowest levels possible, well, if you were looking at your charts, even though you saw it sell off 1 day, 2 days, 3 days, you would have noticed that over here on that day that it sold off really hard, there was a support area right there. Y'all see that? And it went up and it came back down. Guess where, guys? To that same support area. You could have just sat back and waited just like all of us, and then bought your options to the upside. But how can you make money to the downside? So let's talk about shorting real quick. All right. Talk about going long and short and puts. Now, this is part of my webinar. I spend about 10 minutes talking about this. A short position is when you're take a security and you're trying to make money on that stock going down in value. So in the stock world, we call it going long and going short. If you ever hear anybody talking about going long, all right, that means that they're trying to buy something to the upside. If you hear them talking about going short, that means they're trying to take a position and make money to the downside. Now, the options world, going long and going short is synonymous with buying a call or buying a put. All right. So when you're buying a put in the when you're buying a put, you're betting on the market going down. When you're buying a call, you're betting on the market going up. So how do you make money? Well, let's do the numbers. Let's say you had $10,000. Let's say you had $10,000, right? And you bought this going long, right? You bought it at, let's just say 429. Or let's just say 430 because that makes it easier. If you bought this around 430, in 1, 2, 3, 4 days, it went from 430, let's just say all the way to 445. All right. I'm going to make this bigger so that you guys can see it. That's your traditional way of trading, right? 430, 430, all the way to 445. So if you take out a calculator, it's very simple to do the addition. If you bought it at 430 and it goes all the way to 445, well, when you subtract those numbers, that means you would have made $15 a share, right? If you bought one share made $15. If you bought 2 shares, you would have made $30. I know there's a negative there. All I did was subtract where you bought it to where it went to. Well, shorting is the opposite. Let's say you decided to short at the 445 mark, right? Well, how much money do you need at the 445 mark? You still need $445, just like you needed $430 here. Now, what confuses people is they're like, well, Joel, I needed 445 here, but then it dropped to 430. So why didn't I make any money? Well, you did make money if you were shorting because you needed 445. But the same distance that it traveled from 445 to 430 was what? 445 minus 430 still is $15. So you're going to look in your account. If you're shorting from here to here, your account's not going to say 445. Your account's going to say 460 because you got in at 445, but every point that it deviates away from where you got in at is going to be your profit. So you could have made money from 430 to 445. You could have made $15. And then you could have said, I'm going to change my position. And now I'm going to short the market. And I want to make money to the short side. Now, you can't be long and short at the same time. Why can't you do that, Joel? Well, think of it like this. You could have made money this way, going long, and then you could have made money this way, going short, and you would have made the same amount of money this way that you would have made going this way. Why can't you go long and short at the same time? Because you can't be betting on something going up and down at the same time because the $15 that you're making here, you're going to lose here. It's going to even out to zero, which is what we call a hedge. Y'all know why hedge funds were created? Hedge funds were created because your regular companies, or let's say your pension fund and mutual fund that's invested in Apple and Microsoft and Google. Let's say they know that the market is about to go down. They know that it's about to go down. But let's say they own Apple. Let's say they own Apple, and I'm going to visually show it to you. So let's go to Yahoo Finance. Let's say I was earning. Let's say I go to Yahoo Finance. Let's say I was buying. Let's say I was in something like AT&T, right? So if I was in AT&T, and I got $100,000 in AT&T. Well, AT&T is paying out 8% a year. That means for every $100,000 I have invested, I'm gonna make $800, right? And I need those funds to live off of. Like these funds need, they need these dividends. If I'm in a stock And I'm looking at charts and I know that it's going to go down. I know the market's going to go down 10 or 15% every year. If I sell my stock, I don't get this dividend anymore. Y'all heard what I just said? I only get this dividend if I'm invested in AT&T. As long as I'm invested in AT&T, every year they're going to send me a check for 8% of whatever I have invested. If I sell that stock, I'm not going to be able to get this dividend. So hedge funds said, bump that. What we're going to do is we're going to keep that dividend. We're going to still make that 8%. But instead of selling it and getting completely out of that stock and not having that 8%, what we're going to do is we're going to short the market, but we're not going to do it in stock because then we have to pay that dividend. Well, you still sometimes are subject to paying the dividends. That's pretty advanced, but we're not going to think about that. But what we're going to do is we're going to buy puts. So even though I own let's say I own $27,000 worth of AT&T, I can go and buy puts. While it's going down in value, my puts are going to make money against the stock that I'm losing money on. So the $15 I'm losing here, I'm going to gain the $15 in a put to the downside. That plus 15 minus 15 means I'm not going to lose any money. But guess what? I still get that 8%. Now, that went over a lot of you guys' heads, which is fine. That's why you guys need to do a consultation. Or you need to just watch this over and over again until it makes sense. So hedge funds were created so that they can hedge their positions. They hedge their positions with options. Okay? So, let's say you were invested in 50 companies, like the spiders. And you didn't want to sell all of your stocks, but you still got about, let's say you got a $100,000 account, but you got about $10,000 still left over. Okay? Let's do the math. Let's do the math here, right? So if I was trying to hedge my position in the spiders, and I'm going to erase all of this. This is what companies are doing, and you guys don't have to do it. I just want you guys to understand on a larger scale what they're doing. What they're doing is they're saying, you know what? If I had 100 shares, if I had 100 shares of this stock, that means I'm going to have $454,000 worth of it. Why? If I had $454 a share, and I own 100 shares, that means I'm going to have $45,000 worth of this stock. That means for every dollar move, I'm going to lose if I have $45,000, that means for every dollar move, I'm going to lose $100. That means if it goes from 454 all the way to 32, I'm going to lose $100 for every dollar move. That means I'm going to be down 21 times 100. I'm going to be down $2,100 if I stay in this stock. If this goes from 454 all the way down to where we're at right now, I can either lose 2,100 or I can buy a put, which represents one contract, which represents 100 shares. And then I can make $2,100 while I'm losing $2,100. And then I still get to capitalize on the dividend that the SPY pays. Does it offer a dividend? Let's check. I get to capitalize off the dividend that the SPY pays. Okay? But then, because I balanced it all out, guys, here's the beautiful part. Because I balanced it out, Once I sell this put, now I can ride it all the way back up to 455 again. And I didn't even get out of the stock. I stayed in the stock, never sold it, made 2,100, literally made nothing, because remember, you're gonna lose 2,100 and make 2,100 at the same time. I hedged myself. And then I'm going to make money when this goes from 430 to 455 once I sell that option and we start to go back up again. I'm going to make that $2,100 again like I did from here to here. That's what hedge funds and some of these advanced traders are doing that you guys have no idea. I see you guys selling your stock all the time. I'm like, why are you guys selling and getting out of things when all you have to do is buy puts against it? Okay? So, all you got to do is figure out how to calculate. Like if you bought a put right here at 443. People say all the time, well, Joel, how do I know how much I can make? Well, you make money on a short when it goes down. That means if you get in at 443 and it goes down to 430, what's the difference between 443 and 430? The answer is 13. You're going to be up $13. The only way you can make money on a put or a short is you got to put in an order to do that. Okay? You can't just say, hey, I want to make money on it going down. You have to literally go in here and place a order. You got to go in there. You got to hit sell. And now I'm shorting 100 shares. Okay? Or if I wanted to buy a put, I would go here. And from whatever position we're at right now, I'm going to go over to the put side. The stock right now is at 432. I go out to whatever time frame I want. Let's just go out, to next week. Let's go to October 14th. And then that put would cost me $578. That's right, guys. For $578. I'm going to control $43,000 worth of the SPY. So you heard what I just said? Let's say I use $43,000 to own 100 shares of the spiders, and it dropped $2,100. I could have spent somewhere around, let's say $600 or $700 or maybe even $1,000, which isn't 43. I could have spent about $1,000. Bought a put, made $2,100 while my $43,000 was losing $2,100. Sell my put once I think we bottomed out. And then from whatever price we're at lower, because I own 100 shares, I'm going to make that profit all the way back. All right. That's called hedging your position. All right. Let's say you wanted to day trade. Let's talk about day trading. All right. Let's look at Microsoft. Now, when you're using the What Would Joel Do method, and let's go look at these methods, all right? Let's go look at these methods. The What Would Joel Do method, when you're buying a call, is always buying on the third or the fifth wave, or the odd waves. So you only buy on waves 1, 3, or 5. Wave 2 and wave 4 always tells you where to put your stop. So if you're using the Ichimoku and you see it go up, down, and starts to go up, Joel gets in, stop is in place. Let's say you were buying a put. This always cracks me up when I show this. It's the opposite. All right? It cracks me up every time. All right? So you're going to do the same thing. It's going to go down, up. That's where your stop is. And then you get in on the third wave. 1, 2, Joel gets in. 1, 2, Joel gets in. It's the complete opposite when you're buying a short or a put. Your stop loss is going to be above the second wave. Okay? So, let's say we wanted to go short today. All right? Let's say you wanted to make money today. Joel's going to use about $20,000. you're going to buy an options contract. We don't know how much the options contract is yet. Joel always teaches to buy things that are down, you short. Things that are up, you go long. It's really that simple. And Joel's going to use a 1 minute chart. So let's just say we wanted to trade Square today. First thing we look at is the ATR. Square is going to move $8 a day, period. I don't know why you guys are not using that. It's going to move up $8 or it's going to move down $8, but the average move of the day is around $8. Joel is only going to take this trade if it's below the Ichimoku, and it looks like this. It has to go, this is the Ichimoku, it has to go down, up, and down. Joel gets in. That's the only way Joel's going to get in, but now I know that it can go down $8. Now here's the beautiful thing, guys. I haven't looked at any of these stocks today. I didn't even, the only preparation I did for this was those 2 or 3 slides y'all saw. That's it. And y'all know when I prepared those slides, in between the Ask the Trader and this video. All right, this charts with Joel. So I have no idea what Square is going to do, but I'm going to show you how to trade it, whether you would have lost money or made money. So I know that it can move $8. Joel's not going to trade Square unless it goes underneath the Ichimoku. Now, I'm going to use what's called an active Ichimoku. The only way Joel's going to trade this is we have to be below the Ichimoku, period. We got to be below it. This is the Ichimoku line, this yellow line right here. If we're not underneath there, Joel ain't trading it. But he's going to do the opposite. He knows that Square is going to move $8. I know that. They give you this number every day and y'all don't even use it. Somebody tells you every day how much that stock's going to move and y'all don't use it. I don't understand why. Every single day. That's an average. And then it calculates the volatility for you guys that don't know how to look at the VIX. So the first thing I'm going to do is if I want to short something like Square, I'm going to say to myself, A, it's the opposite of going long. That means if it can move from here to here to $8, it can move from here down $8. About average. So I'm going to go to the highs of the morning and I'm going to put out a line. Then I'm going to say, what's 8 minus 242? For those that don't know how to do math that great, you're going to say 243 minus 8 equals 235. That means Square can possibly go to about 235. So if it gets around 235, guys, don't short. It's hit its maximum. I come across traders for years, don't even do this. I'm like, how do you make money every day? You just go out there and guess what you think the stock can do? Yup. Some days I make money, some days I don't. I'm like, oh my God. So I go to 235, and unless I have enough room for me to make money, Joel won't take this trade unless I have room for this to run to 235. Now, it didn't quite get to 235 today. It got to 237, but that's why it has to have room to run. Joel's going to take trades around 9:45. So, what am I looking for? Joel's going to look for something that goes down, up, down. All right? So, you're going to look for a move that goes down from here, down, up, then down. With the goal of getting in, so this is 1, this is 2, Joel gets in. 1, 2, Joel gets in. Looks like this. The opposite. 1, 2, 3. How much are you going to make? Well, if you don't have a spreadsheet that has the cost of the things that you're trading, you're going to have to try to figure it out very quickly. So if I was to get in right around 240 and it goes down to 235, I need to figure out how much I'm making per dollar move. So if you buy some at 240, we're just doing the maximum. I need to figure out, okay, if I got $10,000 and I'm buying some at 240, how many shares am I going to buy? I'm going to buy 41 shares. That means for every dollar move, I'm going to make $41. That means if it goes from let's say it goes from 240, I do the opposite sometimes if I want to really calculate it. So if I want to make $5, I just add it to what I did. So I know it's not going to 245, but for you guys that can't do the math, as you can see, if it goes $5, I'm going to make 208. How did I get that? I took the 42 or the 4150 times 5, which gives you $200. Okay? So, is that a trade that I want to take? If it can get to 235, I'm going to make my $200. Well, as you can see, it only went about $3. That means I was up about $120. How much was I risking? That's a question that most of you guys don't do. Well, if I get in at 240, Joel says that if I get in somewhere around here, 240, 239, my stop, 1, 2, 3, you get in somewhere around here, your stop is right up here. It never reached your stop until here. It went $120 your way, and then it came up here and it stopped you out above the Ichimoku. Because then it started to go back up in price because it got close. Didn't quite get there, but it got close to the maximum move that it can make. But if you're an advanced trader, you still would not have lost any money. You were up $120 even though you were only risking about 40. You were risking about $1, which was $40, but it went $3. That's a 3-to-1 ratio. That's the ratios that you want. But let's say instead of using $10,000, you wanted to buy a put. You wanted to buy a put. How would you have traded this? Well, 1, 2, Joel gets in. You would have been in somewhere around 10 o'clock. How do we know this? Because that's when the third wave started. 1 wave, 2 waves, 3 waves. Joel would have been shorting somewhere around there. You had from 10:02 all the way till about 10:15 to make a decision. So we're going to look at options. Joel used $10,000. You're not going to use $10,000. Now, I hate buying options the day that they expire. I hate doing it. But if you're going to do it, you have to get in and out the same exact day. But I don't teach that. So we're going to go 1 week out to October the 8th. How does Joel know? Oops, let's go on this side. Sorry, I'm on the wrong side. How does Joel know which put to buy? Joel is going to buy the put that has the most volume, period. This put right here that has 448 would have been the put that I bought. It probably would have been this one or this one. Because yes, you're right. They could have interchanged, and within the last 3 hours, this could have been the one with the most. This could have been with the most. But we know for a fact these would have had the most volume. We're just going to go with this one, the one that's 448. Now watch this. When I add this to my chart, Joel used $10,000. He was up $120 after, in about, 10 or 15 minutes. You're going to buy a put. This confuses everybody when they do this. Because when they pull up this chart and they see it going up in value, they're like, Joel, I'm buying a put. I don't understand why it's going up in value. Because don't you want to make money? But Joel, the stock is going down and the put is going up. The put's supposed to go up when you're looking at the chart. All right, look, when you guys are looking at your options, you want it to go up in value because that's where you make your money, even though the stock is going down. Remember, you're buying a put, so you don't want the put to go down in value. You want the put to go up in value. That confused a lot of you guys just now. That's fine. Take a consultation with me. Remember that what would Joel do method? It goes up, it goes down. You start to get in. You remember that time I told you guys to get in right around 10 o'clock? You would have bought the same option Joel bought. You would have bought it right around this price right here. For, let's just say $500, just to keep everything simple. You bought a put for $500 right around 10 o'clock. By 10:23, that put had gained $100. Now, Joel used $10,000, took a short sale on the spiders. He was using stock. He was up about $120. We don't know if he took his profit or not. He wanted to make $200, but it didn't quite get to that $5 range that he thought it was going to go to. He was only risking, out of that $10,000, he was only risking $50 out of his whole $10,000. It went 120. He brought his stop to break even. He either made his $100 for the day or he broke even. Trader B says, I don't want to use $10,000, Joel, but I want to trade just like you. Trader B says, I'm going to use $500. And in 15 minutes, Trader B was up $100. Joel was up 120. Trader B was up 100. Trader B used $500. Joel was using $10,000. But Joel, the option went up because the option is supposed to go up if you want to make money. But the stock is going down. Yes, because you bought a put. A put makes money on things going down. All right. This is not the chart of the spiders going down. It's the chart of an option going up because the option was going down. Well, what's happening right here? Probably the stock is going up because you bought a put. Your put went up in value. You could have got out at 600 if you wanted to. And now it's down. Where is it now? Okay, now it's sitting at 480. You bought it for 500. It went to 600. You didn't put your stop in place. It went past your stop. You said, please, Lord, let this come back. It finally did. And I think some of you guys should get out of your put going down for the day because it's 12 o'clock. All right. Again, buying puts and going short can be very confusing to a lot of you guys. It really can be, unless you know what's going on. I'm going to do one more. Okay. So let's look at Tesla. Before I even look at Tesla, are you buying this going long or going short? It should be going short. Why? Because it's down when you're day trading or scalping or getting in and out the same day. You got to go with the momentum of the market. I keep telling people that. You want to be a 1%er like me, you better trade like me. How much does Tesla move on a daily basis? I don't know, Joel. It just moves. I just buy it and it moves. Tesla moves $20. Did you know that? Tesla moves $20 from what? It moves $20 from the highs to the lows. Is it 20 up or down, Joel? I don't know. It depends on the momentum of the day. If it's a down day, it's going to go down $20. If it's an up day, it's going to go up $20. Word? How come my teacher didn't teach me this? Because your teacher probably don't trade. Period. Keep telling y'all that. Y'all better vet the people that's teaching y'all. Tesla moves $20 a day. Before I even trade Tesla, and I swear to God, guys, I have not looked at none of these charts. I just know how to trade. Let's look at Tesla. Joel is only going to buy Tesla if it's below the Ichimoku and it's the third wave and it's at 945, period. Joel ain't trading it any other time. Why? Because there's 1,000 stocks for me to pick from. Why do I have to trade Tesla? I ain't gotta trade Tesla. Okay? So, what happened with Tesla at 9:30? Well, some of you guys bought Tesla to the upside because you said, it's on sale. I'm going to buy it to the upside. Joel got up at 9:15. I got up at 9:15 this morning. Rubbed the sleep out of my eyes. Stumbled downstairs. Well, I brushed my teeth. Stumbled downstairs. Like, whew, what am I going to trade today? What's Tesla doing? Ooh, Tesla down. Tesla moved $20. Great. So I'm going to go to the early morning. I'm squinting because I can barely see. And I'm going to say, all right, if I short Tesla, it's probably going down to 762. Joel, how did you figure that out in 2 seconds? Because the ATR says $20. It's at 780. It's probably going down to 760 if it's going down in value that day. So I'm going to go down here. If I decide I want to short Tesla, I'm going to go to 760. And I'm going to put, if Tesla starts to drop, guys, and I'm shorting it, I'm probably going to short it to this value right here. 9:30 comes. The bell rings. Y'all run out there, y'all buying Tesla to the upside. Joel looks at 9:30 and says, dang, this is red and we underneath here. I'm shorting. I knew that within 1 second. Y'all still, I don't know when to trade. I gotta flip from this chart to my 15-minute chart to my day chart. I gotta figure out if it's bullish or bearish. And I'm like, who are you learning this from? Obviously somebody that ain't trading. I just woke up 10 minutes ago and knew which direction Tesla was going. And the bias of the market has been down. I say, but am I going to buy it at 9:30? No, because that's when rookies buy. I keep telling y'all that. Anybody that say they can trade a 9:30 market is a rookie and can't trade. I'll tell it to them to their face. Joel said, I ain't trading this unless it comes up 25 to 50% and then goes down. I say this on every video. A stock's going to drop 25 to 50%, or if you're shorting it, it's going to go up 25 or 50% before it starts to go down. Y'all make trading so difficult, and it's the easiest thing ever created because y'all don't know what to look for. Y'all take these courses and pay 5 figures for it, and all they doing is fooling y'all, trying to trick y'all into some advanced stuff that don't even freaking matter. And then when I come out and I do it, Joe, you just be hating on everybody. No, I'm not. These fools can't trade and y'all can't see it with your own eyes. Because what I teach works on every single solitary thing that you trade. You can't pick a stock and you don't see the same patterns. That's how you make it in this game. Not trading 1 or 2 things, trading everything. They tell you how much it's going to move right here. Yet nobody talks about ATR but me. Nobody. Y'all got my alerts. So Joel, with your alerts, how do I know when to get in and out? You didn't take a class, did you? You just took the alerts, didn't take a class. I took your class. Well, did you write down the notes? Because the same tone that I got right now, I make with y'all with this ATR. It's the most important thing ever when you're trading. How do you know where it's going to go to? Just like in investing, if you don't know how big the company is, how you know how much money you can make? I don't know, Joel. It just goes up. Isn't it just going to go as high as what a person's willing to pay? No. Apple's not going to go up 10,000% like it did in the last 20 years. Joe, you just negative. No, I just am real. You just living in some... you're living in la-la land. And a lot of you guys are in la-la land all the time. And then when I try to shake you up and say, guys, get with the real, you get mad at me. Get mad at yourself. Tesla was an easy trade. It went down, it went up. It did everything I told y'all it's going to do. Look at all that money you could have made. And all you had to do was say, It's underneath the Ichimoku and it's gonna move $20 and it went down, up, down. Joe, that's just not complicated enough for me. Because if everybody knew that, it's just not that easy. It is that easy. You make it hard. I get that all the time. Joe, anybody that says something is easy, they just no, it's easy. You just complicate it. It's easy. It's easy. It's easy. Joe, how did you know to make money on Tesla? I looked at a 200-day moving average and I said, ooh, look at what direction this bad boy going. How did you know, Joe? How did you know? Because when stocks get above their 200, that means people are buying it? You didn't know that? And then they stair-step going up. And as long as they stay above their 50 and 200-day moving average, look, it comes down to the 200-day, you buy it, and then it keeps going higher. How did you not know this stuff? Because you never learned the basics. Y'all have learned the crap and never learned the fundamental basics of the market. Luckily, I learned the fundamentals and the basics early. And then I learned the advanced stuff. And then I was like, guys, this advanced stuff is ridiculous. Like, this stuff don't matter. And I threw away all of the advanced stuff because I said this stuff is ridiculous. I could make a killing teaching it to you guys. But I choose not to. I want to continue to teach you guys the basics so that you understand the markets. But let's go back to Tesla because y'all want to figure out how much you could have made. Y'all gonna get mad when you see how much you could have made. It's gonna piss you off because a lot of you guys are long right now saying, please come back, Tesla. Please come back. Please. Please, baby, please come back. Now, did it reach the value that we thought it was gonna go to? Nah. It hit a low, it got up, it hit a low, then it got above the Ichimoku. You could have made money twice on this, 4 times. You could have made money here. Y'all just think that more advanced is better. It's not. You could have made money here. You could have made money from 777 to 769. That was, from 767 to 765. What? You could have made a $10 move on Tesla. Jeez Louise. Y'all know how much money that is? If you had, let's do the math. Let's do the calculator. It's time for the calculator. It's time for the calculator. All right. So look, check this out. Let's say you got in at 776 and you bought $10,000 worth of it. And it goes to 776. If you want to try to figure out if you're shorting, if it's confusing you, just say if you're looking for a $10 move, just multiply that times 786, and that'll kind of tell you how much you could have made if it goes $10 your way. All right. So you could have made your $100 a day if you were using $10,000. Let's say you wanted to use options. So if it moved this $10 move, I was up $100. I know you guys are like, but Tesla moves. Yeah, but let's look and see what the option would have done. So what are you looking for? You're looking for 3 waves. 1 wave, 2 waves, 3 waves, right around, well, this is 9:45. So you can get in a little bit early. 9:37 ain't bad. 9:38 ain't bad. You're going to get in somewhere around 9:40. Now we're going to say 9:38. Joe, how do I know which option to pick? Well, Joel never buys an option the day that it expires. Never. Never. Never going to buy an option the day that it expires. But what Joel will do is he'll go out 1 week. He'll look for the option with the most volume, which is this one. Actually, I need to put more on here to see if there was one that had even more than that. So I'm going to go to October the 8th. Oh, dang. I'm looking at the call side. We're buying puts. So I'm going to go to the put side. And I'm going to buy the put with the most volume. Which put is that, Joel? Is this one at 700? But Joel, you really think Tesla's gonna go to $700? I don't care. I'm only gonna be in it for 15 minutes. I can care less if this goes to 7. But Joel, doesn't it have to go to 700 for you to make money? No. Who taught you that? Your options teacher? You paid $10,000 for? No, it never has to reach this strike. Who taught you that? Craziness. Why do I sound like this? Because I'm getting sick of y'all getting took by these teachers. So I'm going to buy this option right here. I'm going to buy that put. Now, I'm going to get in right around 938. Joel used 10 grand, was up $100. You decide, I ain't using 10 grand. Joel, you crazy. I ain't using 10 grand. I'm going to use 938. That option. Is this right? Oh, that option at 938. This is 938. That option at 938 is going to cost you $1,000. $1,000. All right, and 80. It's going to cost you $1,080. Joel used 10,000 because Joel just be out here fronting. Joel just be out here stunting with all this money when all he should be doing is buying options. Joel used 10,000. He only made 100. You're going to use 1,000. 10% of what Joel uses. Joel made $100 at the highest when it hit its mark at 10 o'clock. At 10 o'clock, your $1,000 would have been worth $1,340 shorting Tesla. You were betting on it going down. You were up $340, which is a 34% return. You just made a 34% return in 20 minutes buying a put. Using the same strategy that I've been teaching for I haven't been teaching it for over a decade. I've been using it for over a decade. Be using the same method, okay? So, for you guys that are confused, shorting. It's when you're just betting on the market going down. But you can't say I'm shorting with a put. No, shorting is a stop term. So if you hear people on TV say, hey, we're going to short Tesla, that means they're betting on it going down. Now you know how they make money. If they say they're going long, that means they're betting on the market going up in value. If you hear somebody say, I'm buying puts, that means they're betting on the market, or they're betting on, not the market going down, because you can buy puts on the VIX. You can buy puts on things that go down when the market goes up. I know it's kind of weird. It's like the inverse. But that's for you complicated traders that love some of you guys just love complications and complicated relationships, complicated situations. You only understand complicated things. That's why you go and spend $40,000 on a class on stuff that you don't understand because you think what you don't understand is how you make money in this market. No, it's not. If somebody can't explain what they're doing in one sentence or within 15 minutes, you shouldn't be taking it. Okay, it should be explained on its most simplistic terms. Okay, I got traders, you got to have 15 different things line up for you to buy it. And y'all swear for cheese that that's it. No, it's not. The market goes up or down. There's either momentum to the upside or downside. Y'all keep making stuff complicated. Stop doing it. Trading and investing is mad simple. The people that can't understand it or say that it's not, they're probably the complicated ones. Because Joel was up in all his accounts all year long. There ain't an account that I ain't got that ain't up. All right? There's some stocks that I got that are down. Who cares? But my accounts are up. And my accounts are up because A, I can trade multiple things because I keep it mad simple. And B, I don't complicate it. It's either going up or down. It's either hitting a resistance area or a support area. You got to know where it can go. Okay? Once you're able to do that, once you're able to have A plus B, C is easy. But y'all don't do that. Y'all will have A. Joel, I got $1,500. What should I invest in? What the hell is your goal? This person wants that $1,500 to go to $1 million. You might just only want to make $150 in 6 months. There's a totally different strategy for that than something else. And I see y'all doing that in the room all the time. Y'all will come with me with B. I don't have A or C. And for you math whizzes, y'all understand what I'm talking about right now. I need at least A and C to get B. I need B and C to get A. I need A and B to get C. Y'all come to me with A or C or B. You gotta have two in order for me to figure out what you want to do. And that's why trading and investing is complicated for y'all. Because you have A, I want to make a whole bunch of money. Or you got C, I don't want to lose a whole bunch of money. I can't work with that. I need A plus B and then an explanation. And then I'm able to help you and you're able to help yourself. All right. So this was just for shorting. All right. This was just, I know normally when I do this segment, I take your stocks, I look at them. This session was strictly for those that were interested in, shorting or buying puts. All right. But if you need to get educated, I want you guys to go to my PayHip. And if you go to my PayHip, you're able to download products right now. If you can't wait till October 12th through the 14th, and I'm going to put the link within this. I also added the link to the last video. You can get educated right now. If you want one-on-ones, you can book a consultation with me. It's just that I can't do consultations for the next 14 days. All right. So if you want a consultation, you want to get ahead of the crowd, start booking 2 weeks out. All right. Hit me up in Messenger. I'll help you out. But for those that want my products, you can go to my PayHip and you can buy the bundle packages, or you can go to the What Would Joel Do party recordings, and there's a video for everybody. If you need something, Mission Impossible Kids, you got something for your kids, you got something for your day traders, you got something for your people that just want to learn how to read charts. You got the how to buy a stock. If you need to have your charts look like mine, you got the Thinkorswim chart setup. If you want to learn options, which we talked about today, there's a video for that as well. Or if you want to learn futures, we didn't really talk about futures today, but it's just a tool that a lot of day traders use to day trade the market. But I'm coming to you guys from Decatur, where it's greater. It's Friday. Y'all know I'm going to be out and about, and I'm out of here. All right. I stopped working right now. My vacation starts now. Later, guys. Peace.